Welcome to the Well-Rounded Retirement Podcast with John and Jim from CRIS Financial. In this podcast, we help you take a well-rounded approach to retirement planning so you can retire with complete certainty. If you're looking for proven and straightforward retirement advice, ranging from how to protect your assets to how to spend with confidence, this show is for you.
Hello and welcome to Well-Rounded Retirement with Jim Donewald and John Glowacz from CRIS Financial. Good morning, Jim. How are you?
I'm doing just fine. How you, Eric?
I am doing fantastic. I know you're running the show today, and you have brought a special guest on the show, and that is Michael Siebold. How did you guys meet and start working together?
Yeah, I'm excited to have Mike join us today. Mike works for a company called Bell & Associates, and I've known him for a while now, and he's been in the financial field for, over 30 years. I know him from the insurance industry and more from the tax-efficient space, and I think this is my third podcast now where I've been dwelling on taxes and tax planning and tax prevention, so that's important to me. So I wanted to bring Mike on today, maybe get a little different perspective here, and to hear a different voice as to how this works in this tax-free space. Are you there, Mike?
Yeah. Hey, Jim. How you doing?
I'm great. Hey, one of the things we were talking about, as we get started here is I'm always looking to do the tax conversions, whatever. So I want to convert my IRAs, 401ks to tax-free retirement. Can you tell me what you and your firm do and how you look at that?
Yeah, no, I'd be happy to. And couldn't be more relevant right now. We just had a major election. We don't have final results yet, but even aside from that, everyone certainly anticipates taxes to be higher in the future for all the reasons that you and I have discussed, Jim. We've got a significant debt level as a country. We've got an aging baby boomer population that's drawing down on social services and one of the lowest tax rates we've ever had. So prudent tax planning is certainly relevant. And so specifically to the question, a lot of folks are wondering, hey, I did what I'm supposed to do here. I've saved and invested in my 401ks and my IRAs for 25 years. I'm now approaching the stage in my life where I'm looking for a distribution plan. How do I turn that savings into income? And more applicably, gosh, it'd be really good if that income wasn't taxable. As we know, those dollars have accumulated for a long time on a tax-deferred basis. But at some point, there's distributions have to be taken. There's taxes on those distributions. And so a traditional concept around turning that tax deferred into a tax-free or an after-tax bucket is a Roth conversion. So you convert from a traditional IRA, a tax-deferred IRA, into an after-tax IRA called a Roth. And mathematically, that makes sense for a lot of clients. I'm 60 today. I got $1 million in my IRA. My money manager Jim does a really good job for me. And when I get to be 70, I'm going to have $2 million. So I'd rather pay taxes on the $1 million today than the $2 million in the future. However, I don't want to write the check. The cost of a Roth conversion for that client would be $350,000 today. And the joke is I'm going to write this check to Uncle Sam and get hit by a bus tomorrow and never see the benefit of it. So the question begs, is there a better mousetrap? Is there a more efficient way to enact that conversion? And that's where our firm comes in. So Bell & Associates, we focus on tax-efficient distribution income planning, retirement income planning. And that conversion strategy specifically, we are using a different after-tax vehicle. Instead of the Roth IRA, we're using a life insurance policy. And there are a number of differences between those two strategies, but the most important difference is that life insurance strategy that we're using builds cash value. And that cash value can be utilized to satisfy the taxes on the conversion. And so that way we are not coming out of pocket for that $300,000. We're simply using the cash that's already growing for us to satisfy those taxes. Does that help?
Yeah, absolutely. And that was the one main reason I brought John. That's a little bit different than I've been talking about so far as to how to address these taxes. But it is funny when I ask all my clients when they come in, I said, so how much of your 401k have you earmarked for the government? and they never like that. They never like that question. You and I have worked on a couple of deals, and I know part of the strategy too is, to help them with some of these unexpected things, such as long-term care. Nobody wants to talk about it. It's the elephant in the room. But what I have found is most people aren't opposed to long-term care. They're just opposed to paying for it. Can you tell me a little bit? I know in our plans we put together with you, that's kind of built in and takes a lot of the pain away from it.
No, that's a very good point, and I'm glad you brought that up. So the traditional long-term care insurance world is really going away. It's decreasing rapidly, and there's a couple of reasons for that. The primary reason really is the underwriters at the insurance company have a really difficult time pricing that risk. They have a difficult time understanding whether Jim, you, or I are going to be healthy and happy into our 80s, or one of us is going to end up in an assisted living facility. Probably you, not me, but that's neither here nor there.
I was thinking the other way around, but that's just
ironically
me. Okay.
You were. Yeah, of course you were. Of course you were. So the question begs, is there a better way again? Is there a more efficient way to protect against that risk? And the industry is shifting in the direction of what we call hybrid long-term care. And hybrid long-term care really simply means it's a insurance policy that has two benefits built into it. The insurance death benefit can be accessed tax-free while you're alive to help pay for your cost of care. So the message to the client is, we know contractually we get a benefit here one way or another. If we are fortunate enough to never need help in our never need assisted care, then that death benefit is, of course, part of our estate and paid to our beneficiaries. However, if we do need care, wouldn't it be great to have a pre-funded tax-free bucket that we can utilize to pay for that care cost and hopefully avoid being a hindrance on our loved ones?
Yeah, I like the sound of that much better. As much as I don't want to think about it, I know I keep reading the stats. It's something like 70% of us at some point are going to need some kind of long-term care, whether it's a hip replacement or short-term, maybe long-term, who knows? And it's just one of those things. I've never seen people so devastated as when they don't plan for that. That's just one of those expenses nobody likes to talk about, but if it affects your family, it's huge. One of the other things I wanted to talk to you about was, whenever I bring up insurance as part of the retirement plan, which we do a lot of over here, people are always amazed at what I want to say is the returns that we can get on those funds, so to speak. So how do you explain these guaranteed lifetime incomes through the insurance products? I mean, what is your process, and what do you guys invest in? How is that even possible?
Yeah, no, great question. So that's extremely relevant where we are right now. The stats tell us that there are 10,000 baby boomers, folks born in the baby boomer generation, turning 65 every day. And that's pretty staggering. 10,000 every day. That's going to continue for the next 4, 5, 6 years. And what happens when we get to that stage of the game? Well, we are less concerned about accumulation. Maybe we're not working anymore, and we're really concerned about maintaining lifestyle in retirement. And how to go about achieving that, and what's really the industry is woken up to that risk, and they've looked at the ability to help these clients achieve those goals. And so one of those ways is utilizing an annuity product that's issued by these insurance companies that essentially gives you the ability. You give the annuity company, the insurance company, a lump sum of money, and in return from that, you get an income that is guaranteed to last your entire life. And the way the insurance companies are able to provide those guarantees really goes to the law of large numbers. They literally have, the insurance company, tens of thousands of customers buying these products at various ages, and they're taking all of those premiums, investing it for very long-term, very safe returns. As a matter of fact, 90% of their portfolio is A-rated investments or stronger for a very long duration. That's how insurance companies work. So in exchange for you giving them a lump sum of money, they are in turn giving you a lifetime income. But here's the good news. A lot of folks hear that and they think, oh gosh, if I were to be hit by a bus a year later, I lose all that money. That's not how these newer products are created. not only do you have access to liquidity when you need it at any time, if you were to not need income or you take partial income and then something terrible happens and you pass away, whatever's residual inside that policy is also part of your estate and paid to your beneficiaries. So we've got that protection built in as well.
So these days, I mean, I see it on the front here all the time as far as these different options. I remember, if you go back 5-10 years, your choice was the S&P or the S&P. What kind of indexing, or how are you getting these great results that you guys are getting? How do you pick what you're going to put the money in?
So the insurance company underwriters are also evolving with technology in the financial world, in the fintech space. And the S&P was always and will always be an option with these, but really what the direction of the industry is going into a much more diversified index. So not just stocks, but stocks and bonds and commodities and interest rates and gold and real estate exposure and multiple countries and multiple jurisdictions. So it's really a global diversified portfolio managed by some of the largest investment companies in the industry. Names like JP Morgan and BNP Paribas and Merrill Lynch are managing these index to create low volatility, so very consistent, not giant returns, obviously, but we also don't have losses here, which really makes it advantageous. We know that there's no downside risk, and these diversified indexes allow that return to be smooth and consistent over a longer period of time.
Yeah, I love it. I mean, we manage money at our firm, and you guys manage money, and it's I don't have the option of not ever having a downside or having a down day, I should say. It's nice when you have some of these investments that have a floor in them and you just can't lose money. I don't know how anybody can pass up on that opportunity. One of the other things, Mike, you and I talked about in the past was, funding these retirement plans by leveraging bank financing. Can you explain that? And who is this for? How does that work?
Yeah, no, I appreciate that as well. So for certain clients that qualify, these are generally higher net worth clients, somewhere around a $5 million net worth and some income. We have the ability to go to lenders that we have a relationship with. These are large banks that everyone's familiar with, and borrow money to really overinvest into these life insurance policies, max fund them as we call it. And the strategy works extremely well right now because we're in a very, very low interest rate environment. Just today, the Fed Powell came out and said he's keeping rates near zero for the foreseeable future. That wasn't a surprise to anyone. So because of COVID and even the economy slowing prior to, interest rates are rock bottom. So we are able to borrow millions of dollars for these customers that qualify at under 2% interest rates. And being able to leverage those dollars and minimize the out-of-pocket expense for these higher net worth clients. These are for clients that could potentially put $500,000 in cash into a life insurance policy, but realize that they are a business owner, there are investments in real estate. They could better deploy that capital elsewhere. And so if they can go and borrow money at, say, 2%, as opposed to, and take that money that they didn't put in the life insurance policy and go buy another project, well, it's advantageous for those type of clients. So that's a really intricate case, but it adds tremendous value for those folks where it makes sense for.
Well, and that's another reason I wanted to have you on here. Here at CRIS Financial, we're right in the oil corridor. So we've got clients that run the gambit of, $1 million to $10 million, who knows, but we're here to help them with whatever their needs are. So when we get these larger clients and they're looking for these opportunities, I want them to know that we have these options available. And along that line, too, is you kind of touching on that higher net worth. What about taking your IRA and helping it with a charity, or we're always talking about saving the clients on taxes. I see you in your notes, you call it disinheriting the government. How does that work?
Well, I think that might be an important comment, 2 days post-election here. There's a lot of people that are concerned. Well, people said that 4 years ago, I'm moving to Canada if Trump gets elected. I didn't see anyone going to Canada. Sorry, I digress. So good question. So as clients get older and they do build up assets inside of their IRAs, which again, where most folks have the most of their savings and investments because they followed what they were told to do by large investment companies and maxed out their 401ks And now they're getting older, and now they're thinking about passing those IRA assets along to their family and beneficiaries. And unfortunately, passing an IRA to a beneficiary is a taxable event to that beneficiary. And so the taxes can be substantial, reducing the amount of the effectiveness of that gift. And so if you have clients that have some charitable intention, maybe they've got a charity that they're fond of, or they volunteer at, perhaps their church, and they were interested in addition to leaving something for their family, they would really be interested in leaving something to that charity. There's a simple tool of changing the beneficiary of the IRA. You change the beneficiary of your IRA to a 501c3, to a charitable organization. That IRA passes 100% tax-free to that charity. So, you're saving $300,000, $400,000 in taxes, and then the charity gets the full benefit. But that family probably still wants to take care of their loved ones. And so what we've done, our strategy is let's change the beneficiary. Let's provide for that charity. We're taking required minimum distributions out of these IRAs because we have to, because they're required. Let's take some of those dollars and buy a life insurance policy. Let's buy what we call a second to die or a survivorship life insurance policy on the husband and wife. And that their demise, the charity gets the full value of the IRA tax-free. The beneficiaries, the loved ones, get the full value of the life insurance tax-free. And as I love to say, we've just disinherited Uncle Sam because there's no taxes due on either of those transactions.
Well, sounds like a win-win to me. We have a lot of people, thank God, are very generous and help out a lot, and that's something we've been able to take advantage of as well. How about in your repertoire and the plans that you guys offer? What happens if you buy one of these plans, let's say, but decide later on you no longer need it? Are you able to get any of your funds back, or how does that work? Do you have any kind of what we would call return to premium products, anything like that?
Great question. So it's interesting, Jim, being in the life insurance world. I jokingly say if you're walking down the street and you say life insurance to someone, they'll probably walk the other way. But if they don't walk the other way, but if they don't walk the other way, many people understand the need, and they understand the need. They also understand that sometimes it could be in sunken cost, particularly term insurance. Term insurance, life insurance that covers a specific period of time, of course. There's about 2 to 3% of term insurances actually pay a death benefit. 2 to 3%. That's why it's so inexpensive. The insurance company knows that it's highly unlikely you're going to die between ages of 40 and 60. So what we have is a product that operates in the same capacity, but it's a permanent insurance policy. But what we like about it is this. For that same individual that really wants that coverage while the kids are young, until they get off, or until he retires, or there's a period of time that they really want to cover, call it 20 years. But instead of the term insurance where after 20 years there's nothing left, with this policy, after that 20-year period, you can turn the policy in and get all your money back. So you've had that. It's almost like buying term, and then if you don't die, well, you get the money back. It costs a little bit more than term, but again, you get your money back, and so as opposed to a sunken cost. And so that's become really popular. And I do work a lot with my advisors and use that product in lieu of term insurance for that very reason.
We're always looking for new cutting stuff like long-term care. When I started doing this, we had the long-term care policies that nobody wanted. They're expensive. Now the hybrids have gotten much more efficient. Term insurance, I'm with you. I'm in that same. If you're a young man, where else are you going to get $1 million worth of coverage if something happens? At a reasonable price, it's got to be term insurance. But like you said, the odds of that paying out are pretty slim. That's what makes it so affordable. Speaking of that, when we always talk about insurance, people always think, at least I get this a lot, that insurance is expensive. And I always say compared to what? Why is it expensive, compared to what you're getting here? So when you look at the insurance, and I know you and I have this conversation a lot about the efficiency of it, but you're comparing it to, mutual funds or other investments. How do you see life insurance expenses adding up to something else they might do incomparable in retirement?
Good question. There is a connotation that life insurance is expensive, and I'll pick on the Susie Ormans of the world, or the Dave Ramseys of the world that go on their pay-per-view channel and tell you the last thing you should do is buy life insurance for growth. So can it be expensive? Yes. If it's improperly designed and improperly utilized, it absolutely can be expensive. And I've seen those policies. One of the things that we focus on at Bell & Associates is efficiencies. And what we do from an efficiency perspective is really design these policies to be as low cost as possible. And what I mean by low cost, any life insurance out there, that term insurance we were talking about, whole life insurance, which most folks are familiar with, and then some of these IUL policies that we're talking about. With any insurance, most of the cost is in the death benefit. And it's not good or bad, right or wrong, but more death benefit equates to more cost. So as we're designing these policies, and again, speaking my comment earlier about walking down the street and talking about life insurance, that individual you speak with when you say life insurance, their mindset is really around the term idea. It's around, hey, I need $1 million to protect my family. What's the least money I got to pay to get $1 million? So it's a concept of pay a little and get a lot. And what we do is kind of the opposite. We start with how much of your after-tax assets do you want to protect? And based on the funding or the premiums, we back into what's the least amount of life insurance I have to purchase based on my funding. And again, I'm asked, well, Mike, why buy as little as I have to? Why not buy as much as I can? And again, it goes back to cost. And if we're designing these policies, really the primary objective is cash value accumulation. And the best way I know how to make that as efficient as possible is to keep the cost as low as possible. So as we design these policies, we've designed what we call a minimum death benefit, maximum cash accumulation plan, very common in the industry. And what really takes it to the next level, however, some of the carriers we work with, which are a bit unique, have the ability to reduce the death benefit later. So we get 5-10 years down the road, we're done funding a life insurance policy, and we decide, hey, we really don't need $1 million anymore. Kids are grown. We would love to reduce that death benefit to reduce the cost. And that's, again, very common design for us. To answer your question, a properly designed and administered life insurance policy have long-term costs which equate to a typical mutual fund of around 1.5%.
Yeah, that's what we've found. It's funny when you say that, because I always find when people come into our office and they're unhappy with the plan they have, 9 out of 10 times I find that it's not necessarily the plan. They've got it. It comes down to the planning. It's the plan, not the product. And I find that the people that come in, they have a hammer when they need a saw. They were either sold the wrong thing or they didn't understand it. And like you said, this is why it's so important to get to the right people. When it's designed correctly, you can't lose, or at least it's so efficient in my mind. When I look at this, I go, I don't know anything else that can protect my money, take cash out of it, help me with long-term care if I need it. To me, there's so many benefits from it. I wanted to ask you one last thing, and then I kind of wanted to go through that last case that you and I worked with. But so, Mike, I did want to go here at the end here. I want to kind of follow up with some numbers. You and I just worked on a case recently, and we'll just call it Joe. And here's what I'm finding. I don't find this all the time, but this was kind of a unique case where the gentleman had all his assets in this retirement bucket, in his IRAs and his 401ks. And while I find that's typically where most people have most of their assets, I normally still find it spread out. This gentleman had almost everything in tax-deferred bucket. And you helped me put a plan together, so just to give the listeners a little bit of an idea of we'll just call the guy Joe. So I want to go through this plan that we put together for a gentleman named Joe. He had quite a bit of his money, actually he had all of his money in the tax-deferred bucket. And we put a plan together to help him move quite a bit of his money out of the tax-deferred bucket into the tax-free bucket. But since all of his money was in the IRAs and 401ks, we had a challenge paying his tax bill. And you and I, Mike, work together, and you guys have a real nice program at your company, and I think you call it the Qualified Reset Plan. But can we kind of just go through some rough numbers? Let's go through that one that you and I put together and just call him Joe so our listeners can get an idea of how this works.
Yeah, no, happy to. Thanks again, Jim. So Joe is not uncommon. Joe, as you had mentioned, has the majority, or in this case, a significant majority,
all of
not
it,
all, of his assets in a deferred bucket. And again, Joe did what many people do, and that is what the large investment companies like the Merrill Lynch's and Charles Schwab's will tell you to do, is the smartest thing you can do during your accumulation stage is maximize your 401k contributions. Kick the can down the road. The taxes will be way lower in the future. Don't worry about that. Well, the reality is, number one, Merrill Lynch and Charles Schwab and the rest of them might argue they have a vested interest in telling you to do that. Why? Because that's how they make money. They make money by having large 401k balances. And so maybe it's good advice, maybe it's not. I'm of the opinion that we touched on this a little earlier in the call, that we're in for pretty higher taxes in the future. And we know contractually the Tax Cuts and Jobs Act rolls off in 2025. So that's a concern. And it's a concern for Joe. And so we talked to Joe about a solution to alleviate some of that pain. And specifically in Joe's case, we looked at a plan on Joe and Mary, and so to Joe specifically, again, $1 million of the $3 million, we took distributions out of the IRA over 7 years. So $150,000 a year over 7 years. Every one of those distributions, as you alluded to, Jim, is a taxable event. It's added to ordinary income. And so we did an assumption that there's about a 20% tax liability. We owe $30,000 every time we took one of those distributions out of the IRA. So how do we pay that? Well, one option is write a check. You can. No one really wants to, but you can. But what's a second option? Well, the second option is we have this IUL. So when we took that $150,000 distribution this year, we put it into an IUL, and it's growing. Well, next year, when we have a tax bill due on that IRA distribution, we have around $90,000 in cash value inside that IUL. So we're able to borrow out the cash value from the IUL and use that money to pay the taxes. Now, you'll notice I say borrowed out and not withdraw, and let's touch on that because this is a really important concept. These IULs have a feature called a participating loan, which means you can borrow out your assets, but those dollars continue to earn interest on the account as if they never left. So that is unique to this product. So you're borrowing out your money, you're paying a 3% rate to borrow it. This contract is averaged somewhere between 8 and 11. So you pay 3, you earn 8. That's working in your favor, of course. But that's the concept of being able to leverage the cash value inside this life insurance policy to pay off Uncle Sam. So over a 7-year period, we took $150,000 out a year, and then the subsequent years 2 to 8, when we have the tax bill due, we take out a $30,000 loan and pay the taxes. So at the end of that period, we've taken $1 million out of the IRA. We've paid $210,000 in taxes on money we're still earning interest on. That's a great story. Mr. and Mrs. Client, the money we're sending to Uncle Sam, you're still earning interest on that money. And I jokingly say, go to Wells Fargo, tell them you're taking $200,000 out and ask them how much they'll pay in interest on it. So it's a different concept, but unique to this product. So that was the concept. Now he has no more RMDs on these assets. The government doesn't tell him how much to take out or when. He takes out now as little or as much as he wishes to, and he does so tax-free. And he does that tax-free forever. So we showed Joe taking out some money beginning after that 10th year. And Joe's drawing down on that $1 million that we put in the IUL. We paid $210,000 in taxes. And we showed Joe drawing around $80,000. I think it was $84,000 a year, tax-free for the rest of his life to fund his retirement. And that's a pretty good trade-off.
Yeah, tell me where it hurts. I think this program is great. I mean, I love this. Until I met you, I was unaware of this. The way you guys have actually set it up, it works out great. And as a matter of fact, for our listeners, I'm going to throw up an example we have on our website so that if somebody wants to look at this and kind of see some numbers here and see if it might apply to themselves. But I thought this was the greatest thing since sliced bread when you've got a ton of your money in that tax-deferred bucket, because these taxes are coming at us, like I say, whether you think it's going to be a little raise or a big raise. I think they're going up for sure, and you have to address it. And if you're not sitting on a ton of cash right now to pay those taxes, this is a great alternative to that.
All right, gentlemen, I'll be quite honest. This was like drinking from a fire hose. This was so much information, so much great information. I appreciate your time, Michael, coming in. And Jim, I just want to ask you, do you have any closing thoughts for today's podcast?
No, I just want to, we try to give valuable information to everybody. We know what everyone's needs are, but we want to make sure that we've got plenty of information out there for them to decide. There's many choices out there. What I'd like to do, Eric, is put up an illustration on our website after we finish today. So it's just a great example of what Mike and I just discussed through, so people can get a general idea of how this works and see if this is a concept that's right for them. And they can go to Well-Rounded Retirement, and this will be under the white papers tab on that particular site.
All right. Sounds good. Jim, thank you so much for bringing Mike in. Mike, again, thank you so much for being a great guest today.
Eric, thank you. And Jim, good to speak with you again.
Good talking to you, Mike.
And of course, the last thank you goes to you, the listening audience. Thank you so much for tuning in and listening to the Well-Rounded Retirement Podcast with Jim Donewald and John Glowacz. If you have not subscribed to the podcast yet, please click the subscribe now button below. This way, when Jim and John come out with a new podcast, it'll show up directly on your listening device. This makes it much easier to share these podcasts with your friends and family. Again, thanks for listening today. For everyone at CRIS Financial, this is Eric Johnson reminding you to live your best day every day. And we'll see you next time.
Thank you for listening to the Well-Rounded Retirement Podcast. Click the subscribe button below to be notified when new episodes become available. The information covered and posted represents the views and opinions of the guest and does not necessarily represent the views or opinions of CRIS Financial. The content has been made available for informational and educational purposes only. The content is not intended to be a substitute for professional investing advice. Always seek the advice of your financial advisor or other qualified financial service providers with any questions you may have regarding your investment planning.